Welcome to the KBA Vendor Viewpoint Podcast, where we bring together Kentucky bankers and the industry's top vendor solutions to discuss important topics that affect your bank. Here's your host, KBA Director of Membership, Products, and Services, Selina Parrish.
Welcome to KBA's Vendor Viewpoint Podcast, where we bring together Kentucky bankers and the industry's top vendor solutions to discuss important topics that affect your bank. This is Selina Parrish, KBA Director of Membership, Products, and Services. Today we are featuring KBA-endorsed Abrigo. We are pleased to have Laura Clary, Senior Director of Product Compliance at Abrigo. And she is also a recognized payments and risk management expert. As an accredited ACH professional, Laura helps financial institutions navigate evolving regulatory expectations while strengthening fraud prevention, payments risk management, and operational compliance programs. Thank you, Laura, for being on today's podcast. And let's just kick it off. Please tell our audience about your role with Abrigo and how Abrigo is supporting the NACHA risk management rules and the Abrigo services used by Kentucky banks.
Thank you, Selina. In my role, I drive regulatory strategy across Abrigo's product portfolio, translating complex compliance requirements into practical solutions that help banks proactively identify, assess, monitor, and mitigate risk. I serve as a strategic advisor to the product management team and to financial institutions on topics including ACH risk management, fraud prevention, financial crimes compliance, and emerging payment technologies. The biggest message we're sharing with banks today is that NACHA's 2026 rule changes aren't simply another compliance exercise. They're signaling a shift toward continuous risk management, stronger governance, and greater accountability throughout the ACH ecosystem. At Abrigo, we help institutions assess ACH risk, monitor activity, identify anomalies, investigate suspicious behavior, document oversight, and provide meaningful reporting to leadership and to the board.
Wow, that's a lot. And I know our member banks have this at top of mind. And can you explain what prompted NACHA to update these rules now?
Sure, and the answer is quite simple. ACH growth has remained strong and predictable, but fraud growth has accelerated significantly. ACH payments have grown steadily year after year, reaching more than 35 billion transactions annually. At the same time, fraudsters have become faster, more sophisticated, and more automated. The challenge is that ACH volume grows at a manageable pace, but fraud attempts are growing exponentially. That widening gap is where risk lives. NACHA recognized that institutions needed stronger, more mature monitoring programs to keep pace with the evolving fraud threats.
And what are the most important changes Kentucky bankers should understand?
I would group the changes into four major themes. First, expanded risk management requirements. Institutions need documented and ongoing ACH risk assessments, not just point-in-time reviews. Second, stronger monitoring expectations. Regulators and NACHA expect faster detection and earlier identification of unusual activity. Third, there is increased oversight of originators and third-party senders. Due diligence can no longer stop at the onboarding process. And fourth, governance and accountability. Senior management and boards are expected to have greater visibility into risk, including ACH risk. The overarching theme is continuous risk management.
Definitely. And what does that look like operationally for a community bank?
Well, most institutions already have pieces of a strong ACH risk program in place. The challenge is bringing those pieces together consistently. We encourage institutions to focus on 4 practical steps. First, assess ACH risk exposure across originators, transaction types, channels, and customer segments. Next, align policies and procedures with current risk realities and clearly define ownership. 3, enhance monitoring capabilities through behavioral analysis, anomaly detection, and threshold tuning. And fourth, strengthen the oversight through in-depth reporting, documentation, and again, ongoing reviews.
Can you tell our audience, how does Abrigo help banks accomplish all of these goals?
Abrigo helps institutions move from reactive monitoring to proactive risk management. Our solutions help banks identify high-risk originators and customers. They help monitor ACH activity for unusual patterns. They can detect behavioral changes and anomalies. Our solutions support investigations and case management. We document risk assessments and reviews. Our solutions help deliver executive and board level reporting and improve audit and exam readiness. Ultimately, we're helping institutions gain visibility into risk before losses occur.
Wonderful. And one of the things we're hearing across the industry is third-party oversight. Why is that receiving so much attention?
Mm. Yeah, third-party relationships introduce additional complexity and risk. Historically, many institutions perform extensive due diligence at onboarding, but relied on periodic reviews afterward. The updated NACHA expectations emphasize continuous monitoring. Banks need visibility into how third parties and originators are actually behaving over time. And that includes monitoring transaction volumes, return rates, standard entry class code activity, fraud trends, and behavioral changes. The goal is identifying elevated risk before it becomes a compliance issue or a financial loss.
What challenges are you seeing institutions struggle with most often?
Several themes consistently emerge. First, there's fragmented monitoring across multiple systems. Second, there's limited visibility into originator level risk. Third are static thresholds that no longer reflect evolving customer behavior. So put a point in time threshold when the customer behavior is changing, it's very difficult to detect that as the customers what's normal for that customer changes. And fourth, insufficient documentation around risk assessments and governments have been a challenge. And finally, the organizational silos that tend to still remain within financial institutions. ACH operations, fraud teams, compliance, and risk management often have valuable information, but they aren't always working from the same view of risk.
How important is leadership involvement under the new rules?
It's becoming critical. The board and senior management don't need to review every transaction, but they do need meaningful visibility into ACH risk. Leadership should understand who are the high risk originators. They should have a handle on what the return rate trends are. They should understand emerging fraud patterns within the organization. They need to understand their third party risk exposure. Also, have a view into policy exceptions and any corrective actions that have been taken. The expectation is no longer simply compliance reporting, it's active risk governance.
And it definitely seems while I'm on the road visiting KBA members, everyone's worried about fraud. So, how should they think about ACH fraud risk today?
Yeah, that's a really good question because there is an important distinction and sort of trend, and it's a move from authorized versus unauthorized fraud. So unauthorized fraud is often easier to identify through traditional controls. But authorized fraud, where customers are manipulated into initiating payments themselves, is becoming increasingly challenging. So this could be authorized under false pretenses. This could also be the category of account takeover, where they are tricked into giving up their credentials and then payments, move out of their or money moves out of their accounts. Fraudsters are leveraging social engineering, business email compromise, and sophisticated scams to convince customers to authorize transactions. And that means that institutions need stronger behavioral monitoring, customer education, and anomaly detection capabilities.
And if you could leave Kentucky bankers with three key takeaways, what would those be for our audience?
Yeah, so first, NACHA is raising the bar from compliance to accountability, and it's extending to every participant in the ACH network. Second, monitoring must become more proactive and risk focused. And third, I'd say improving visibility into ACH activity, originator behavior, and fraud indicators can significantly reduce risks. Banks can't control ACH volume. They can't slow payment velocity, but they can reduce vulnerability through stronger monitoring, governance, and risk management practices.
Wonderful. That's great information. And for our bankers who would like to learn more, what's the best way to connect with Abrigo?
We'd welcome the opportunity to discuss ACH risk management challenges, demonstrate our solutions, and share best practices we're seeing across the industry. KBA members can connect with us through abrigo.com or through KBA's endorsed vendor program. We'd be happy to schedule a conversation and discuss practical strategies for strengthening ACH risk management programs. Bankers can also connect directly with Joe Hyman, who already works closely with you, Selina, and the
Definitely.
KBA team. Joe would be happy to answer questions, provide additional information, and coordinate a follow-up conversation or demonstration tailored to your institution's needs. Thank you, Selina, for this opportunity, and thank you to the KBA for this opportunity to connect with your members.
Great information, Laura. Thank you so much for taking your time today to be with us and give our audience all this wonderful information about ACH and all these NACHA changes. Additional information regarding Abrigo is available on KBA's website at kybanks.com. And thank you, audience, for being with us. That's all for this episode of KBA Vendor Viewpoint. Until next time, this podcast is a wrap. Have a great day, everyone.